Good evening, dear students. Now let us continue with what we had stopped in the first hour. Hello. Sorry, Pooja. So in the morning class, I was telling you about the various techniques of capital budgeting. So in the various techniques of capital budgeting, I told you that we have the traditional techniques of capital budgeting. We also have the modern techniques of capital budgeting. So under the traditional techniques of capital budgeting, we have payback period and average rate of return method. Okay. And with regard to the, modern techniques of capital budgeting, we have the internal rate of return method, profitability index method, and the NPV method. Okay. Now let us work out the problems based on payback period. Yes, dear students, I told you in the morning class itself that payback period is nothing but the time that is required for us to get back the original investment that we have invested in a particular asset or in a particular project. Okay. Now let us say we have invested 1 lakh rupees in a particular project. We should see within what time, okay, we will be able to recover back that 1 lakh rupees. How many years is required? Okay, so it basically depends upon what cash flows, okay, we are able to generate over a period of time. So let us start with the first problem. So a project cost rupees 1 lakh and yield annual cash flow of 20,000 for 8 years. Calculate the payback period. Yes, dear students, what you need to do here is, since the cash inflows are uniform, that means for every year the cash inflows is 20,000 rupees. So what you can do is, you can calculate payback period using this particular formula. So payback period is equal to original investment divided by annual cash flows. Okay. So original investment is 1 lakh rupees. The annual cash inflow, that is per year, the cash inflow is 20,000 rupees, and thereby the payback period is 5 years. Okay. So, dear students, all of you, please keep in mind the first way of identifying payback period is by using the formula original investment divided by annual cash inflows. Okay. Then, when we have uneven cash inflows, what do you mean by this uneven cash inflows? When the cash inflows is different for various period of time. For example, if the cash inflows are different for 6 months, then the payback period will be 5 years. So, dear students, let us see how to calculate the payback period whenever there is an uneven cash inflow. Uneven cash inflow means to say, for each and every year, whatever cash inflow is there, that keeps on varying, okay, over a period of time. That means in the first year, if a particular project is going to give you 6,000 rupees, for the second year, if it is going to give you 8,000 rupees, third year, if it is 10,000, fourth year 5,000, and so on. That means to say there is a variation, okay, between the first year, the second year, the third year, and fourth year cash inflows respectively. Okay, so all of you keep that in mind. So now let us start with the problems particularly pertaining to uneven cash inflows. Okay, now coming to the first problem. A project requires an initial investment of 20,000, and the annual cash inflows for 5 years are rupees 6,000, 8,000, 5,000, 4,000, and 4,000 respectively. Calculate the payback period. Now, dear students, here you can see in this problem that the cash inflows for each and every year is different. It is not the same. So what you need to do under such a circumstance, Under such a circumstance, the first step is you have to find out the cumulative cash inflows. Okay, what is this cumulative cash inflows? I think in statistics you might have heard of this term cumulative. Okay, that means to say, see, when you look at this particular problem, the first year the cash inflow is rupees 6,000. So the cumulative cash inflow again in the first year, if you can see here, it will be 6,000. The second year, the cumulative cash inflow will be 6,000 plus 8,000. Okay, so this is 6,000, the cumulative cash inflow of the first year. Along with that, if you add the cash inflow of the second year, you get 14,000, which is the cumulative cash inflow of the second year. Coming to the third year, it will be 14,000 plus 5,000, which comes to 9,000 in the third year. In the fourth year, it will be 19,000 plus 4,000, which comes to 23,000 in the fourth year. Okay. So, what you people should keep in mind is cumulative cash inflows computation is very important. Again, in the fifth year, it will be 23,000 plus 4,000, which comes to 27,000 in the fifth year. I hope all of you are understanding. So you have to find out as a first step whenever you're calculating the payback period, and whenever you have uneven cash inflows, that is the cash inflows is different for each and every year. During such a time, you have to go into cumulative cash inflows. So, how will you find out the cumulative cash inflows, dear students? As I told you, in the first year, it will be the same amount, that is 6,000, the same 6,000 is here. Okay, and the next year it will be 6,000 plus 8,000, which comes to 14,000. The next year it will be 14,000 plus 5,000, which comes to 19,000. Again, in the fourth year, it will be 19,000 plus 4,000, which comes to 23,000. And lastly, it is 23,000 plus 4,000, which comes to 27,000. Now, dear students, let me tell you how exactly you are going to calculate the payback period. Okay. The above table shows that. Now, how are you going to calculate the payback period? First of all, have a look at this. Payback period is equal to year before the full recovery of cost plus unrecovered cost divided by cash flows for the next year. Okay, what does that mean? Okay, just a minute. Okay. So now, as I was telling you, how exactly you're going to compute the payback period is that, say, year before the full recovery of the cost plus unrecovered cost. Okay. What is this unrecovered cost? Divided by the cash inflow of the next year. That means to say, dear students, first of all, you have to find out the cumulative cash flows. As I told you once again, I will repeat. See, first year, the cash inflows will be, cumulative cash inflow will be 6,000. Next year, it will be 6,000 plus 8,000. Okay, 6,000 plus 8,000, which comes to 14,000. How did you get this 8,000? Here you have 6,000. Again, here you have 8,000. So 6,000 plus 8,000 comes to 14,000. The next year it will be 14,000 plus 5,000. 14,000 plus 5,000, it comes to 19,000. Again, it will be 19,000 plus 4,000. Okay. So this comes to 23,000. And the last year it will be 23,000 plus 4,000. So it comes to 27,000. Now, dear students, what you need to do is, first of all, look at what is the original investment. So the original investment is 20,000 rupees. Now here, when you look at the cumulative cash inflows, you can find out that in the first year, you're able to get 6,000 rupees. The second year, you're able to get 14,000 rupees. Okay. The third year, you will, by the end of third year, you will be able to get 19,000 rupees. Now, dear students, what you should keep in mind is, see, the original investment, that is the amount that you people have invested is 20,000. Out of that 20,000, okay, or 19,000 you are able to recover during the third year. Okay. So that is why you should highlight this 19,000. Why? Because although the original investment is 20,000, at the end of the third year, you're able to get 19,000 rupees. So that is why how exactly you're going to calculate this payback period is that it will be, yes, it is unrecovered cost. What is unrecovered cost? See, first of all, you have to take the year before the full recovery of the cost. That means to say, three. So 3 years. At the end of 3 years, you were able to get 19,000 plus unrecovered. What is this unrecovered amount? The original investment was 20,000 rupees minus 19,000 rupees you're able to get. So the unrecovered money is 1,000 divided by the cash inflow of the next year. See, now here at the third year, you got 19,000. What is the cash inflow of the next year? It is 4,000 rupees. So when you apply the formula and when you work out, you get 3 years plus 1,000 rupees. 1,000 is the unrecovered amount divided by 4,000, which is the cash inflow of the next year. So, dear students, the payback period will be 3.25. Okay, so that means to say, for you would have invested 20,000 rupees. For you to recover that 20,000 rupees, you will require approximately 3 years and 3 months. Okay, keep that in mind. Now, coming to the next question, dear students, determine the payback period of the project which requires a cash outlay of 10,000 rupees and generates the cash inflow of 2,000, 4,000, 3,000, 2,000 in the first, second, third, and fourth year, respectively. Now, dear students, again, you should keep in mind this is a problem of calculating of payback period wherein the cash inflows are different for different years. So that is why, just like the previous problem, have a look at it. You will make three columns. The first column is the years. The second column, dear students, it will be the cash inflows as it is given. In the first year, the cash inflow is 2,000 rupees. The second year, it is 4,000 rupees. The third year, it is 3,000 rupees. And the fourth year, it is 2,000 rupees. Now, what you people should keep in mind is after writing down the cash inflows, you have to find out the cumulative cash inflows. When it comes to cumulative cash inflows, dear students, it is nothing but in the first year, the cumulative cash inflow is 2000 rupees. And when it comes to the second year, it will be 2000 plus 4000. That is 2000 is the cumulative cash inflow of the first year. Along with that, you have to add the cash inflow of the next year, which is 4000. So you get 6000. See here, the first year cumulative cash inflow is 2000. The next year it will be 2000 plus again 4000 of the second year. So that is how you are able to get 6000. The next year, how will you calculate? You will take 6000 plus 3000. So you will be able to get 9000. And the last year, it will be 9000 plus 2000. Okay, so it will be 11,000 during the last year. So, dear students, in the first year, by the end of the first year, you are able to get 2,000 rupees as the cumulative cash inflow. The next year, by the end of the second year, you are able to get 6,000. By the end of the third year, you are able to get 9,000. Now, why I have stopped over here is that, see, whatever is the original investment, we have made an original investment of 10,000 rupees. But if you can see here, by the end of the third year, we are able to get how much? 19,000 rupees. No, next one, sir. Yes. See, the original investment is 10,000 rupees, but by the end of the third year, we are able to get back 9,000 rupees. So, what you people should keep in mind is payback period is equal to 3 years. Why? Because at the end of 3 years, you are able to get 9,000 rupees. Plus, why is this 1,000 given? 1,000 is nothing but the unrecovered money. That means to say 10,000 rupees was the original investment minus 1,000 rupees, which is what? No, sorry, minus 9,000 rupees, which you are able to recover. So 10,000 minus 9,000, you get 1,000. So, dear students, please listen to me once again. The payback period is equal to 3 years plus 1,000. That 1,000 is nothing but 10,000, which is the original investment, minus 9,000, which you are able to recover at the end of third year, divided by cash inflow of the next year, that is 2,000. So when you take 3 years plus 1,000 divided by 2,000, you will get it as 3.5 years. So it means to say, dear students, for you to recover the original investment, you will require 3 years and 5 months. Okay, you should keep that in mind. Then, coming to the next problem, dear students, it is about the two projects. Okay, now all this time only one project was given. Now they are giving you two projects, and on the basis of these two projects, you have to decide what will be the payback period. Okay, now dear students, have a look at this question. There are two projects, project X and project Y. This is illustration number 4 in your study material. Okay, there are two projects, project X and project Y. Each project requires an investment of rupees 20,000. You are required to rank the projects according to the payback period. Now, dear students, if you have a look at this problem, now the project X has got 5 years lifetime, and in the first year, yes. In the first year, okay, that project X is able to generate 1,000 rupees. In the second year, they're able to generate 2,000 rupees. In the third year, it is able to generate 4,000 rupees. In the fourth year, it is able to generate 5,000 rupees. And in the fifth year, it is able to generate 8,000 rupees. Now, again for project Y, it is given that the company is in a position to recover 2000 rupees in the first year, 4000 rupees cash inflow in the second year, and then you have 6000 rupees in the third year and 8000 rupees in the fourth year. Now you have to go ahead with the calculation of payback period. Okay. So when it comes to this payback period, yes. First, let us take individually. So, first, let us take project X and then look at project Y. See, if you look at the problem, you can clearly identify that project X is having 5 years, and look at the cash inflows 1000, 2000, 4000, 5000, and 8000 is there. So, what you are going to do, the next step is you have to find out the cumulative cash. So, you need to find out the cumulative cash inflows. Hello. Okay, so what are the cumulative cash inflows? See, in the first year, the cumulative cash inflow will be 1000 rupees. In the next year, it will be 3000. Why is it 3000? 1000 plus the cash inflow of the second year. So 1000 plus 2000 gives you 3000 rupees. And in the next year, it will be 3000 plus 4000 rupees, which gives you 7000 in the third year. When it comes to the fourth year, it will be 7,000 plus 5,000, which is 12,000 in the fourth year. And in the fifth year, it will again be 12,000 plus 8,000, which will be 20,000 rupees in the fifth year. Okay. So, all of you, please keep in mind. Firstly, whenever you're getting the uneven cash inflows, you must be in a position to find out what is the cumulative cash inflows. After finding out the cumulative cash inflows, you should start with the calculation. Okay. So now you can see in project X that the cumulative cash inflow is 1000. In the second year, it is. So, when you people look at this concept, what you need to do, you have to find out the cumulative cash inflows. So, dear students, for project X, the cumulative cash inflow for the first year will be 1000, but for the second year, it will be 1000 plus 2000. Okay, so which will be 3000. Then again for the next year, it will be 3000 plus 4000, which comes to 7,000. And again in the fourth year, it will be 7,000 plus 5,000, which is the cash inflow of the next year. So it comes to 12,000. And nextly, it will be 12,000 plus 8,000. So it will be 20,000 rupees in the fifth year. So dear students, you have to again have a look at what is the original investment. So the original investment is nothing but 20,000 rupees. So what you can find out is that project X is able to recover the amount of 20,000 rupees at the end of fifth year. So it goes without saying that the payback period of project X is 5 years. Why? Because at the end of the fifth year, it is able to generate the complete cash inflow of 20,000 rupees. But dear students, have a look at this project Y. For project Y, it is given that 2000 is the cash inflow of the first year, 4000 is the cash inflow of the second year, 6000 is the cash inflow of the third year, and 8000 happens to be the cash inflow of the fourth year. Now, what you need to do, as I've already told you, you have to take the cumulative cash inflows. When it comes to the cumulative cash inflow, dear students, as I've already mentioned to you, the first year the cumulative cash inflow will be 2000 rupees. For the second year, you should take 2000 plus 4000, that is the cash inflow of the next year. So it comes to 6000 rupees. And for the next year, you have to take 6000 plus 6000, which comes to 12,000 in the third year. And for the fourth year, it will be 12,000 plus 8,000, which comes to 20,000 in the fourth year. So here it is very evident that for project X, 20,000 rupees can be got back at the end of the fifth year, whereas for project Y, you will be able to get back the original investment of 20,000 rupees at the end of fourth year. So dear students, the payback period here is very, very evident. You people can easily find that the what is that, the present value, the payback period, okay, sorry, the payback period of project X is 5 years, whereas the payback period for project Y is 4 years. Now, which project is better? Now, the question is, you have to find out if project X is better or project Y is better. Dear students, all of you, please keep in mind, the earlier you are able to recover the amount of original investment, the better it is for the firm, right? Because if you take 4 years to get back 20,000 rupees, after that, whatever cash inflows will be generated, that will be a revenue for the company. But here, when it comes to project X, you can see that it takes 5 years to get back the original investment of 20,000 rupees. Okay, so all of you, please keep that in mind. And then apart from that, for project Y, see, if you can see here, I have given a conclusion. Project Y should be preferred. See, the above table shows that in case of project X, it takes 5 years to recover the original investment of 20,000 rupees, whereas in case of project Y, it takes 4 years to recover the original investment of 20,000. And that is why project Y should be preferred, since the payback period is shorter, that is 4 years. That means to say, within 4 years, you will be in a position, okay, to get back the original investment. So the earlier you are in a position to get back the original investment, the better it will be for the company. So dear students, that is why the payback period for project Y, which is 4 years, is said to be much more better. So that is a better project when compared to project X. Okay, so this method uses accounting information. Are you able to hear now? So the ARR method is also known as the return on investment method, and this method uses accounting information as revealed for the financial statements to measure the profitability of an investment. Now, when you work out the problems on this ARR method, you will be able to clearly get the information about how exactly you have to go about. And usually, ARR method will be a method which will be asked for 15 marks or for 10 marks. Okay, so we will just go to the question now. The first question. ಕೇಳಿಸ್ತಾ ಇದೆಯಾ? Okay. Okay, so let us go to the first problem. See, a limited company is considering investment in a project that requires a capital outlay of 2 lakh rupees. Okay, so there is a company called as A limited company, and this company is considering making investment in a project that requires a capital outlay of 2 lakh rupees. And what is the average income after depreciation but before tax? Dear students, let me tell you very clearly, whenever you are taking the average rate of return method, you have to take cash inflow after depreciation and after tax. That is the first point that you should keep in mind. So in this problem, they have given you the cash inflow after depreciation but before tax. But what do we need? We need cash inflows after depreciation and after tax. So for this, we have to make, okay, the required adjustments. What adjustment do we have to make? Okay, now have a look at this. Now, first of all, dear students, let us see what is the formula to calculate ARR. Okay, all of you very clearly see this. When it comes to average rate of return method, you have average annual profits after depreciation and after tax divided by average investment multiplied by 100. Now this is the most widely accepted formula. So it says that ARR is equal to average annual profits after depreciation and after tax divided by average investment multiplied by 100. Now, dear students, what you need to do is average investment. When you use the word average investment, it means to say net investment divided by 2. See, whenever the classes are happening, first of all, you people must have the material with you. You should have the calculator with you. Okay, it must not be that you people are just appearing like that and you will not be able to know things. Okay, now please keep in mind, as I was mentioning to you, see, ARR method. Okay. Don't worry about sending the slides and all that. Okay, we will be doing it at a later stage. Okay, as of now, listen to this how exactly you can compute. See, when it comes to ARR method, dear students, first of all, you have to write down the formula which says that average rate of return is nothing but average annual profit after depreciation after tax divided by average investment multiplied by 100. Now, what is the numerator and what is the denominator? When it comes to the numerator, dear students, average annual profit after depreciation and after tax means to say, okay, for the numerator itself, you have a formula. So it is the total cash inflows after depreciation and tax divided by the number of years. Okay, so for the numerator, that is when you use the term average annual profit after depreciation and after tax, it is nothing but the cash inflows after depreciation and tax divided by the number of years. But when it comes to the denominator, what is this average investment? Average investment is nothing but the original investment or the net investment divided by 2. Dear students, let me tell you very clearly, I'm not working out any problem outside the syllabus. Okay. So all the problems are very much there specifically in the study material. So whatever problems I'm working out here is particularly from the study material itself. Okay. So now how you have to go about with the problem, I'm going to tell you. See, have a look at this. See, they have given this question. Once again, let me repeat. A limited company is considering investing in a project that requires a capital investment of 2 lakh rupees. Okay. So this is the original investment, that is 2 lakh rupees. And the annual income after depreciation but before tax is 10,000. Now they've given you the depreciation, which is 20% on original cost, and the tax rate is 50%. Now you have to calculate ARR. What you need to do, dear students, please keep in mind one very, very important concept is in your study material also, I have given a box with a note like this for each and every method of capital budgeting. See, in case of ARR method, you need to take the cash inflows after depreciation, after tax. But here, whatever they have given in the problem is after depreciation, but before tax. For that, what you need to do, you have to reduce the tax. See, for cash inflow after depreciation, but before tax, if you reduce the tax, you will be getting cash inflows after depreciation and after tax. Now, dear students, if you clearly observe in the question, they would have given you that the tax rate is 50%. So, what you need to do is because they have given you the cash inflows after depreciation but before tax, your first responsibility is that you have to reduce tax and then you have to start with the problem. How will you reduce tax? See, for example, in the first situation, it is 1 lakh. So you have to reduce 50,000. Why is it 50,000? Because it is nothing but 1 lakh multiplied by 50%. So 50 divided by 100. So that will give you 50,000 rupees. So here 1 lakh again multiplied by 50% will give you 50,000 rupees. 80,000 into 50% will give you 40,000 rupees. Again, 80,000 into 50% will give you 40,000 rupees. And again, 40,000 into 50% will give you 20,000 rupees again. Okay. Now, what you people should know is, now this is the tax amount that you people are deducting. Minus 50,000, minus 50,000, minus 40,000, again minus 40,000 and minus 20,000. So here in the last column, you will be able to get cash inflows after depreciation and after tax. That is 1 lakh minus 50,000 will give you 50,000. 1 lakh minus 50,000 will give you 50,000 again. 80,000 minus 40,000 will give you 40,000. Again, 80,000 minus 40,000 will give you 40,000. And lastly, 40,000 minus 20,000 will give you 20,000. So, dear students, I hope you're understanding. First thing is, if you have a problem on ARR method, firstly you have to see whether the cash inflows that they have given you is cash inflow after depreciation and after tax. Okay, because only if it is in the format of after depreciation and after tax, you will be able to start with the problem. But in this problem, dear students, they have given you after depreciation but before tax, which means to say that the tax component has to be reduced. So 50% of tax has to be reduced for each of the components. So when you reduce 50% for each of them, you will be getting the cash inflows after depreciation and after tax. Now, please message and tell me, have you understood until here? Kindly message in the text box and tell me, have you understood till here? That is the average cash inflows, okay, with regard to ARR. Okay. Now the next step. After doing this, See, this is the one which you will get. Okay. Now, after subtracting whatever you got here, that is 50,000, 50,000, 40,000, 40,000, and 20,000. These are the cash inflows after tax and after depreciation. So, dear students, after making the alterations, required alterations, you will be getting the years as well as the cash inflows after depreciation and after tax. Okay. The next thing is, dear students, you have to go to ARR. I told you that the formula to calculate ARR is average annual profits after depreciation and after tax divided by average investment multiplied by 100. Okay, so the first thing that you people have to write down is you have to write down the formula, and after writing down the formula you should go with the calculation. Okay, so that is what you need to do. Okay. Yes. Look at the question now. Yes. Now, what I did, I wrote the formula average annual profits after depreciation and after tax divided by average investment. Now, dear students, I already told you what is the numerator and what is the denominator. Now, average annual profit after depreciation and after tax is nothing but the total cash flows that you get, the total cash flow that you get after depreciation and tax divided by the number of years. Okay, that means to say, see here, total you got 2 lakh rupees, right? 2 lakh rupees divided by the number of years, that is 2 lakh divided by 5. 40,000 rupees is the average annual profit after depreciation and after tax. Now, when it comes to the average investment is the net investment divided by 2. Net investment is nothing but 2 lakh rupees divided by 2, which comes to 1 lakh rupees. I hope you are understanding. So, dear students, what you need to do is first find out what is the numerator, next find out the denominator. After that, you need to do the numerator divided by the denominator. See here, 40,000, what you have calculated here. This is the numerator. Then 2 lakhs divided by 2, that is 1 lakh, is the denominator. So ARR will be 40,000 divided by 1 lakh multiplied by 100. When you do that, you get ARR as 40%. Okay, that is the ARR. So before going to the next problem, tell me that if you have any doubts. Yes. So, dear students, what you need to do, because this FM happens to be practical paper, see, when you look into your study material, okay, so the study material is nothing but whatever I'm working out now, all this is mentioned in the study material. You have to work out the problems repeatedly because I have mentioned to you the step by step explanation. It is very much there in the study material, so it will really be useful in case you people practice on those problems, because each step I have tried to explain to you so that you will not have any type of confusions. Okay, so now let us go ahead with the next problem. This is again a problem on ARR. All of you listen to me. X limited company is considering the purchase of a machinery. Okay. Now, this X company has got two machineries in hand. One is called as the machinery E, and the second one is machinery F. What is the cost of the machinery? The cost of the machinery is 60,000 rupees. The machinery has a life of 5 years. The net profit after depreciation but before tax. So because they have given us before tax, you have to do it as after tax is given below. You have to calculate ARR. Okay, now let us see. I'll try to work out the problem along with you. Okay. Now, dear students, for example, insert table. I'm inserting a table. Okay. Let us see. Yes. So the first column is year. Next column, they've given you the profits, profit after depreciation, but before tax, right? Before tax, they have given you. So it means to say you have to reduce the tax. You have to reduce the tax. You will get profit after depreciation and after tax. Okay, now let us work out. Okay, so straightly I will take away whatever is given. Okay, now here is first year, then you have the second, I mean, sorry, then you have second year, then you have third year, then you have fourth year, and then you have the fifth year. Okay, now let us see what are the cash inflows that they have given in the question. The cash inflows are, yes, 15,000, 20,000, 25, 15. So first year you have 15,000. Second year you have first year 20, 15,000, second year 20. Next year you have 25,000. Then you have 15,000 and 10,000. Okay. Now you have to reduce the tax. What is the percentage of tax that is given in the problem? It is given as 50%. So here you have to take 15,000. Sorry. You have to take 15,000 into 50 divided by 100. So how much does it come to? 7,500 is the tax. The next one, it will be 20,000 multiplied by 50 divided by 100. So divided by 100. So this comes to 10,000. Next you have 25,000 into 50 divided by 100. So it comes to 12,500. Then you have 15,000 multiplied by 50 divided by 100. It comes to 7,500. Then you have 10,000 multiplied by 50 divided by 100. It comes to 5,000. Okay. Then when you reduce it, so it will be first column, that is the profit after depreciation but before tax, less tax when you do. So 15,000 minus 7,500 will give you how much? It will give you 7,500. Okay. Next year, 20,000 minus 10,000, it will be 10,000. Next year, 25,000 minus 12,500 will be 12,500. Next, it will be 15,000 minus 7,500, 7,000. Last column, 10,000 minus 5,000, it is 5,000. So if you can see here the same answer. So you have 7,500, 10,000, 12,500, 7,500, and 5,000. It comes to 42,500. So dear students, what you need to do, write the formula. ARR is equal to average annual profits after depreciation and after tax divided by average investment multiplied by 100. Now, what you should do again in the numerator, you have a specific calculation to make. What is that? See, average annual profit after depreciation and after tax means to say the total cash inflow after depreciation after tax divided by number of years. Okay, that means to say, see, just now I was doing that, I worked out and I left it here. Yeah, 42,500 divided by the number of years. Okay, what is the numerator equal to? 42,500 divided by 5. So here if you can see 42,500 divided by 5. So 8,500 is the numerator, and whatever is your average investment, that is nothing but net investment divided by 2. What is the investment amount that they've given? 60,000 divided by 2, which is 30,000. So dear students, ARR will be equal to 8,500 divided by 30,000 multiplied by 100, which gives you 28.33. See, because I have told you now, when you take your study materials and if you're able to clearly look into the problems and work out, you will definitely be able to understand. Okay, so step by step explanation is there. Only thing is, you people should work out the problems as much as is possible. Okay, now again, let us go to part B. This is for machinery F. See here, even here the same thing. They've given you the cash inflows after depreciation but before tax. Okay. So what you need to do, I told you that under the average rate of return method, you have to take the cash inflows after depreciation and after tax. So what I will do is, for whatever value is given here, I am going to reduce the tax component. That is, in the first year 5,000 is there. So I reduce 50% of 5,000, which comes to 2,500. In the next year, you have 15,000. So 15,000 minus 7,500 I will do. And again in the third year, 20,000 is the cash inflow. I have to reduce 50% of tax, that is 10,000. And in the fourth year, 30,000 minus 50% of it, that is 15,000. Again 20,000. So tax is 10,000, you have to reduce that. Then you will be able to get 2,500, 7,500. Then you have 10,000, then again 15,000, and again you have 10,000. Okay. So dear students, these are all the concepts that you have to mainly remember. After calculating that, what you need to do? Yes, you will have to write the formula. Yes, dear students, as all of you know, ARR is equal to average annual profit after depreciation and after tax divided by average investment multiplied by 100. Now, what is this average annual profit after depreciation and after tax? It is nothing but the total cash inflows after depreciation and after tax divided by the number of years. Okay. So here I had made this calculation, right? See, you get here 45,000 is the total. Andre, after reducing tax, whatever values we got, we have to take a total of that. So 45,000 divided by the number of years. Okay, that is how many years? 5 years. So you get 9,000. What is the denominator? Average investment. Dear students, average investment is net investment divided by 2, which will be 60,000 divided by 2, which is 30,000. So ARR will be 9,000 divided by 30,000 multiplied by 100, which will give you 30%. So dear students, see here there is a table which shows the ARR of machinery E is 28.33%, ARR of machinery F is 30%. So when you compare the ARR of both these, whichever has got the highest average rate of return, that machinery should be actually preferred. Dear students, when it comes to payback period, the lesser the number of years, the you should prefer such a product, okay? Because it means to say you're able to recover that amount within a shorter period of time. But when it comes to ARR method, higher the percentage of ARR, it means to say the project can be preferred. Okay, I hope you're understanding. Just a minute. Yes. Okay. So are you understanding the average rate of return method? So as I told you, the first thing is you have to see whether you are able to get average, annual cash inflows after depreciation and after tax. In case it is after depreciation and before tax, first of all, you have to think about reducing the tax component. After you reduce the tax component, you will be able to get average annual cash inflows after depreciation and after tax. Okay. Later on, what you need to do, you have to put the formula. After putting the formula, you have to make the calculations. And dear students, all of you, please keep in mind, higher the average rate of return, it is better for the company to go in for such type of an investment. Okay, so that is about the ARR method. Okay, so please remember, ARR method happens to be one of the popular questions which will be repeatedly asked in the examination. Okay, now here, just a minute, let us go to this one problem wherein we can work out payback period as well as ARR. Even this question is also very much there, okay, in your material. Okay, see, a limited company is considering investing in a project which require capital outlay of 2 lakh and the income after depreciation but before tax is given below. Okay, so the same way. Yeah, but before tax is given below, you have to compute, not this one. Where did it go? One second. Yes, it was illustration one. Yes, yeah, this problem. So now they have given you the cash inflows. They've given you that the depreciation is 20% and taxation is 50% of net income. You have to find out payback period, ARR, NPV, profitability index. But we will just work out for payback period and average rate of return since we have learned only those two methods. Okay. Now, dear students, see here what I'm going to do. Yes. Please remember, for computation of payback period, okay, and NPVIRR, you need cash inflow after tax before depreciation. Only for ARR method, you need after depreciation and after tax. Okay. Now, what you will do is, for example, first we will go to payback period method. Now, dear students, cash inflows after tax and before depreciation. For this, you have to make some alterations. Yes. See here, in the first column, you will take the years. They've given you cash inflow after depreciation and before tax. So, what you do, you will take those values, and you know that once you reduce the tax component, you will be getting cash inflows before depreciation and after tax. Dear students, if you add back the depreciation, you will be getting cash inflow before depreciation and after tax. That means to say, whenever you are working out any 15-mark question, first of all, you have to see whether the problem is in a required format or not. Only then you have to go ahead. Okay. Wait, I think this is a direct problem and this is also a question paper problem. We can work out this. See, identify the average rate of return on a project. That is ARR, they're telling you to calculate. They've given you that the original cost is 56,125, and for machinery B also it is 56,125. Okay, and the average, I mean, additional investment on working capital is 5,000 rupees and 6,000. Estimated life is 5 years. Salvage value is 3,000 and 3,000. The tax rate, dear students, it is given as 55%. And one second. Yes, they have given the tax rate as 55%. Okay. And they've given you the income after depreciation and tax. That means to say directly they've given whatever is the income after depreciation and after tax. So, dear students, have a look at it. Now, here they have directly given you the income after depreciation and after tax. So, what you will do, you will write down the cash inflows for machinery A. Whatever is the cash inflows, you will take it directly, because even though they have given the tax rate, they are clearly telling you that the cash inflow after depreciation and after tax has been considered. And you directly write down the formula. ARR is equal to average annual profits after depreciation and after tax divided by average investment multiplied by 100. Now, dear students, I already told you that in this ARR method, you have two classifications. Okay, that is, you have to calculate separately for the numerator and separately for the denominator. Now, average annual profits after depreciation and after tax is nothing but the total cash inflows after depreciation after tax divided by the number of years. Okay, so that is nothing but, as you are seeing in the problem, 36,875 divided by 5. When you do that, you get 7,375. Now, dear students, there is a small adjustment that you should remember. When it comes to the denominator, I have told you what is average investment. Now, average investment will be original investment divided by 2. But if the scrap value and the working capital amount has been given, if in the question the scrap value and the working capital amount is given, then the denominator, that is the average investment, will be original investment minus the scrap value divided by 2 plus the working capital plus scrap value. Now, again, as I'm again telling you, this problem is also there in your material. So you can go through from that. So the average investment, dear student, is the original investment. That is 56,125 minus the scrap value, which is 3,000 rupees, divided by 2, plus the additional working capital is how much? 5,000 rupees, and again the scrap value. So what you need to do, 56,125 minus 3,000. When you do, you get 53,125 divided by 2 plus 5,000 plus 3,000. So the average investment, that is the denominator, you are getting it as 34,562.50, whereas for the numerator, you are getting it as 7,375 rupees. Okay. Now, how will you compute the ARR? Of course, 7,375 divided by 34,562.50 multiplied by 100. So, ARR for machine A, dear students, is 21.30. Lastly, I will explain for machinery B. See, the estimated income after depreciation and after tax. In the question itself, they have told you that it is the income after depreciation and after tax. So it's not a worry for you. All the values have been already given to you, but you know that you have the scrap value as well as the working capital. So ARR is equal to average annual profit after depreciation after tax divided by average investment multiplied by 100. And I've already told you average annual profit after depreciation after tax is equal to total cash inflow after depreciation after tax divided by number of years. Okay. So that is nothing but 36,875. Yeah, there's a mistake, divided by 5, which comes to 7,375. And dear students, when it comes to average investment, it is nothing but this formula you need to use. original investment minus the scrap value divided by 2 plus additional working capital plus the scrap value. So you have 56,125, which is the original investment. The scrap value is 3,000 here again, divided by 2 plus 6,000, which is the working capital, plus 3,000. So you get 53,125 divided by 2 plus 6,000 plus 3,000. So here you get the answer as 35,562. So again, when you find out the ARR for machinery B, dear students, the ARR for machinery B is 20.75. So here, just a minute. So you have ARR for both the machineries, machinery A and machinery B. So machinery A, the ARR is 21.34%. For machinery B, it is 20.75%. So as I already told you, dear students, higher the ARR, the better preferred is that particular project. So, dear students, let me tell you once again that capital budgeting decisions happens to be one of the important components from your exam point of view. So, you can expect almost up to 25 to 30 marks questions from this particular chapter. So, you need to know that there are two techniques of capital budgeting. One is the traditional technique of capital budgeting, and the other one is the modern technique or the discounted technique of capital budgeting. So, under the traditional technique of capital budgeting, we have the payback period method, we also have the average rate of return method. But when it comes to the discounted cash flow technique, we have net present value technique, we have internal rate of return method, we also have the profitability index method. So in today's class, I have told you about the payback period method as well as the ARR method. Please keep in mind, payback period is nothing but within what time you will be able to recover the original investment. Okay, for that I told you that either you will be having the even cash inflows or you can be having the uneven cash inflows. When there is uneven cash inflows, find out the cumulative cash inflows and find out the payback period. And when it comes to the ARR method, dear students, you have to first of all find out whether you are having average cash inflows after depreciation and after tax. Only after bringing it to that particular format, you people should go ahead with the calculation. Okay, so please refer to the study material wherein step by step calculations are there. Work out the problems regularly so that you will be having an idea of how to approach for the examination. So concentrate on the theory as well as the practical aspects. Okay, so go step by step, and all these problems which I've been doing for you from the first day, everything is very much there in the study material itself. Nothing is outside the study material. So if you go through all those problems, you will be able to do well. Thank you, students.